greetings in this fine hour. That's a dog, so excuse me for that. I hope he wouldn't bother this episode that much, but nevertheless, let's continue. And what I want to say, that today I'm going to discuss one important aspect of investing costs, and that is inflation. Surely you have heard of inflation and the fact that long-term inflation erodes value of any currency that there is. Like if you see purchasing power of dollar in like 1940s, 1970s, and today, that you will see that naturally dollar was worth more previously than it is today. And I am not saying you something new whatsoever. But here's the thing. How many of investors and traders actually have implied this same principle in investing? Namely, that value of their investing should have been calculated in context of inflation. Now, what that means in practical terms is that when you are calculating your potential returns, not only you should deduct your investing costs and your possible taxes depending on your tax structure, but also how large inflation probably will be or was in previous periods where you calculated returns of your investment, and that will be the real value of what you have made. For instance, if you have made 10% after all the fees and all the taxes that you have to pay, you still have to see what was the inflation of that period, because if inflation was 5%, you're actually making 5%, not 10%. And that's equivalent of 50% of commission of your earnings or 50% tax. Now, if someone would want you to deduct 50% tax of your investment income or any kind of income, you would be furious and you would think that taxman is ripping you off, or investment provider or broker to whom you are working with would be like loan shark, not legitimate service provider. But no one says that about inflation. No, because firstly, obviously no one is calculating this in that regard, and there is very little that you actually can do to avoid the cost of inflation. But still, the costs are very real and they have profound impact on your actual returns. So this is something that you clearly have to look at. Are there ways to avoid it? Well, there is not. At least not in conventional ways. Like you might not take your money out, or you could spend it towards your real investments or whatnot, but really there is practically no way that you could avoid inflation. But that's the thing you have to consider, and you have to take that into mind, that whether you're depositing money, investing in bonds or fixed income securities, investing in stocks or trading or doing some speculative investments in financial markets, you really have to take those costs into consideration. And that's the thing, that's the thing what I'm trying to say here. There is nothing much you could do, but it gives you a clear picture of how much you are making. Like there is very real examples of this right now. At the time of recording this video, which is early 2023, we had prolonged time of very low interest rates, in which effective value of deposits for last 10 plus years was actually negative. So that means if you deposited your money at 2009 or 2010, you not only you made extremely little value of your deposit payments, because there were none of, especially if you were near Europe, they fluctuated between very little negative payments to zero payments to extremely small payments. And this picture is only changing in recent months when central banks started to raise their interest rates. But still, this value was actually negative for 10 years. The money you put into deposit versus money you took out now is less valuable than it were. That's the fact. And even if you invested into bonds, the returns on bonds similarly was so weak that those percentage returns were lower than inflation. And of course, in fact, that 2022 showed that there might be situations when rate of inflation is higher than rate of potential fixed rate income of all the securities one can imagine, except for extremely high risk junk bonds. So that means that you might make 5% on your deposit on your bond coupons, which could be like, yes, 5-6%. But if real inflation is like 10%, you're actually losing money at slightly slower pace than you would if you had invested in deposits or simply holding that into cash. And that is value. No, this is not a value, this is role of inflation. And the examples are very real. If you compare prices at like late 2021 and now, you could extremely well witness extremely well the purchasing power of your money, because the fuel prices have risen, food prices certainly have risen, utility prices have risen, and everything else as a consequence to that have risen. So you like, this is not something imaginary, this is real, that you could really see that you are spending, you have less spending power that you had before. So there is nothing to do, this is the part of the game, and to be objective you have to consider this into your calculations. Now you might say that maybe you could try to invest in something more profitable that could beat inflation, or into products that are linked into inflation, some bonds which are changing their coupons depending on inflation rate, or other types of financial products. Well, that might be the case, but it's also that's no magic pill, because increased investment returns might increase risk, and not everything is guaranteed in this world, especially if we are talking about financial markets. So unfortunately, I cannot give you any kind of good news or quick fixes, apart from the fact that if you will be more self-aware and more self-critical about investments that you have, you will be more realistic on what you could actually make. And in long term, that would certainly help you, because it would put you down to earth, make more realistic investing and trading plans, and that would increase your chances to make some good money out of that. And that's how financial markets work. There are visible costs like brokerage fees, which you have to pay anyways. There are investment costs such as taxes, which you have to pay, and which has a significant role on your investing performance, but you actually have possibilities to structure them correctly so these costs are minimized. And there are unseen, sort of invisible costs such as inflation, which actually erodes your investing performance and your purchasing power of your money and your investments. But there is very little that you could do to that, but simply you have to be aware of that, so that you know how much you actually have and how much you actually could make with this factor taken into consideration. So that's that. And if you want to see more similar content which gives you value in your trading and investing, of course make sure you are subscribing me and following my channels. So till next video, stay tuned. Bye.